Hello, everyone. Thank you for joining us. We would like to introduce Dan Pembleton, the CEO and President of Accident Capital Management. How are you doing, Dan?
Great. Thank you very much.
Thank you. Thank you for being here. Well, it's our first market series, so I think we should talk about, the elephant in the room right here, right? Which would be inflation. What do you think, Dan? Obviously, after COVID, there was a huge government response, a lot of fiscal and monetary stimulus, and we're seeing prints in the U.S. of above 5%. In what camp are you? Do you think this is transitory, or this is going to be more permanent going forward?
Yeah, it is the elephant in the room, and it's a difficult one to define. Certainly, I believe what we're seeing right now is a spike in inflation that has a number of elements to it. I think there certainly is a restriction of supply that is being experienced. So and that is happening in a number of different ways. You hear anecdotal stories about shipping costs, trucking companies not being able to find sufficient truck drivers. You hear certainly the lumber story made some big headlines, although I don't think lumber is a very good indicator either way of inflation. But the circumstances surrounding that are maybe a little bit telling as to in the bigger picture what's going on. And I think the very high inflation that we're seeing now, and make no mistake, it is very, very high when the GDP deflator comes in at 6.1% in the second quarter, on top of a 4.3% print in the first quarter. That is very high inflation. And the whether this is transitory or not is certainly the question that's been out there with Fed governors and strategists, and really, and certainly for the average consumer as well. What I personally believe is, I don't think the 4.5% or 6% level of inflation is something that will persist for multiple years. However, I certainly can see the building blocks being put together for something of 3% or higher, and it could, I could see 4% plus sticking with us for another year before easing off further. And the reason I say that is, certainly the supply restrictions have been there, but demand is also being released. If you look in the last GDP report, consumption was up 11%. That's really been carrying the day in terms of GDP growth, which at a 6.5% print in the initial the advanced Q2 report was under the expected 8.5. I give that a lot of leeway because predicting GDP in these kinds of circumstances is extremely hard to do. So 6.5 is still a very, very strong economy, but it's clearly underpinned by consumption, and we have also seen alongside that a spike in inflation. So we have demand picking up. We have some restricted supply in certain areas, which are causing price increases, and we have to let this play out a little bit and see where things go. But I do believe the baseline of inflation is going up. You see a lot of companies on their earnings calls, and again, this is anecdotal, and these are forward-looking plans from these companies, but a lot of these companies, they're seeing higher input costs, and their plan and their reaction to these higher input costs is to increase prices. Whether those price increases will stick or not, that certainly remains to be seen. But I think if you have so many companies who are looking to raise prices, that it seems like price competition is going to be reduced in the future in an environment of rising costs. So that tells me baseline inflation, it has definitely upward pressures on it, and we'll see what that happens in terms of expectations as well, because that circles back into people's union wage negotiations, but individuals' wage negotiations as well. So and that also has a circular effect on inflation as well. So I believe we've got higher inflation ahead.
Well, yeah, and you're seeing a lot of companies raising wages, right? There's starting to be wage pressures in certain sectors, mainly low-skilled jobs. But yeah, no, it's crazy, and you cannot have persistent inflation if you don't have wage growth, right? With it, but well, unless it's monetary. But well, you were a former bond trader. Then, if inflation is at 5-6%, why did the bond yields roll over from, I don't know, maybe I think they peaked at 1.8%, 1.7%. Why they rolled over and now they are at 1.18%? It seems like the bond market is saying the opposite. The bond market actually believes that this is going to roll over, and we will just go back to 2%.
Yeah, this is a real mystery for me. I'm really glad I'm a former bond trader and not a current bond trader, because this is a very difficult environment. I feel that those traders are definitely like a long-tailed cat in a room full of rocking chairs. That this is a very risky situation for fixed income. You've got, with these prints of inflation that we're seeing, you've got real yields touching minus 300 basis points. That is exceptionally low real interest rates, and if you're a 10-year U.S. Treasury holder, you've just been smacked with a near 2% loss on real yields, not a trading gain on the price, but on if you're a buy and hold, with inflation printing where it has in the first 2 quarters of this year, your real purchasing power of the money you've tied up in a 10-year bond has been reduced, and it looks like it's going to be further reduced. So the question is, why are bonds not reacting? And not only not reacting, they're going in the opposite direction. I think there are real, and keeping in mind the Federal Reserve is buying a lot of these bonds. They're buying $80 billion of treasuries every month, and they're buying $40 billion worth of mortgage-backed securities. So the actual free trading amount of the bonds issued is considerably lower than what the headline looks like. And I believe this has set up conditions in the markets where where market participants and certain people just do need to hold federal paper, and the supply of that has been restricted because the Fed has its thumb on the scale, and so we get these kind of outsized and sometimes, at least for me at the moment, curious moves in the opposite direction. You wonder, okay, are bonds expecting a recession? Are they expecting that inflation is going to disappear, or what are driving these things? I believe that it's hard to get a true read because the Federal Reserve is so heavily involved in the bond market. I don't think we know what a true fair price of 10-year debt is in the U.S. and that's a risk for. Frankly, it's a risk for the entire financial system. If you can't properly price the risk-free asset that everybody uses as a base for pricing all the risk assets, certainly you could be putting a lot more risk into the financial system than perhaps maybe the interest rates are reading into it right now. But as a bond trader, I'd be very confused. I would just be going with the flow. If I see more buyers, then I would get on that side.
Well, you manage Pavilion closed fund that is mainly commodities and precious metals. Obviously, with inflation, we've seen the commodity cycle move, and the reopening trade and commodities are doing really good. But you are basically saying that the Federal Reserve is debasing the dollar, right? So shouldn't we see, if we are back to levels of minus 3% real yield, shouldn't we see gold starting to move? Why has it been consolidating for the past year, not moving, when we are having a perfect scenario for gold to do great? Why hasn't it been moving?
Well, I think it actually has been a pretty healthy consolidation. A 6 month to 12 month, and even in a bond bull market, you can get 18-month consolidations that happen. It moved significantly, off of the $1,100 range. Yeah, I'm talking about gold. Yeah.
Market,
yeah. Sorry. Yeah. It's a gold bull market, and certainly it's an epic bond bull market too. Hopefully I think that one is turning, but the bond bull market, it moved significantly off of the bottom from $1,100 up to nearly $2,000, and consolidating in the $1,800 range for almost a year now, and that could go on a little bit longer. Why has it not broken out? It certainly it should and you would expect it to, given what's going on in a monetary debasement scenario. And I think we're also seeing that, and it's not just the U.S. Virtually every central bank has expanded their purchases of bonds and created and printed a lot of money, and governments fiscally have also distributed a lot of money, and this this is something that but I also think on the same side this is also an element of the inflation that we talked about. Certainly there's a lot more money chasing the same or fewer amounts of services and goods, and I think that that part of it is starting to economically act normally. Whether when we get with the timing that we get of the next move in the gold market, that one's very difficult to say. I think part of it too, though, is we've seen equity markets rally very, very well, and when people see equity prices going up, and they the bond market seems to be dismissing inflation. I think they feel an element of safety in sticking with what has been working for them. So they continue to invest in equities. They perhaps at their own peril ignore some diversification into the gold sector. And all of this works very well until it stops working. And so we may need to see the equity rally start to plateau a bit, and then people will start to look around for other assets. And that is just an element of it. I think we just need a few more months to see how things start to play out. I don't know whether the bond market and investors will continue to have so much patience if we continue to see inflation come in at higher than 3% quarter on quarter for too much longer, because it starts to get just a little bit too expensive to hold some of these negative yielding assets.
Okay. What's your view in the market? I mean, Goldman Sachs came today and upgraded the S&P to 4,700 by the end of the year. What do you think? Do you think we could hit that? I mean, earnings were great. Most of companies have been beating them. The economy looks good, even though the Delta variant is there damping some growth, especially right now in Asia, for example, in China. But do you think we can keep seeing the S&P having the same?
The momentum is there. I think it's one of those situations that, the earnings were great. People may start talking about, well, was that peak earnings? Hard to know. But earnings are there. Liquidity is certainly there, being provided by everything. Central banks, fiscal actions by the governments. There's lots and lots of money floating around the system, and even in an inflationary environment, we'll see this money getting spent. That consumption that was up 12% or near 12% in the second quarter. That money got spent, but it got put into somebody else's pocket, and that's going to get spent. So there's an enormous amount. There's an enormous amount of stimulus that has been put into the system, and there's a lot of momentum in the economy, and certainly that has shown up in equity prices. I don't know how high this could go, but certainly it's not a trade I would stand in the way of. I think it's one of those where you recognize that it's a very, very expensive equity market. You try to find things that are reasonably priced in that market and won't surprise you in a downturn. I think we will get a downturn. It may not be 2021. It might be 2022. It will happen, and we just kind of have to make money while we can. But keep in mind that this is a very expensive market. There's a lot of momentum on it. You can see that there's a very high willingness in even the average investor to speculate and go way out on the risk curve, more than they have been willing to in prior years. And this could have unexpected results. The pendulum swings both ways. Timing it is maybe a little bit perilous, but I think what you want to do is set your portfolio up for a scenario that's not as rosy as it is right now. And I think gold will break out. I do believe inflation will be higher. You've got to set up a portfolio that's willing to withstand those kinds of conditions. And bonds I think are probably the most dangerous asset out there right now, just because they've been so heavily influenced by central bank purchases.
Okay, so what you're telling me is mainly the S&P, you still believe it's going to keep going higher. Well, I agree with you. There is nowhere else to go, to be honest. Where are you going to go? You're not going to leave it in a bank account at minus 3% a year. You are not going to... You won't put it in bonds if you are smart. Well, unless there's some diversification benefits, but you're also losing money there. So you have to put it in the market, right? Another thing that has been competing with gold is Bitcoin. And it's just because of that, because we have negative real interest rates, and we don't see when we're going to move away from this environment. Last thing, I know you are a big commodities guy now, and what do you think about oil? I personally think it's a little expensive now, and it's starting to roll over. Do you think it will roll over from here, or we will continue to see it going higher, above $70 a barrel for WTI?
Yeah, I expect oil will consolidate. I think the the $60 to $70 barrel range. I think OPEC Plus is, although they have their moments, I think they are protecting that range fairly well and bringing on the supply that they've been holding back, as a significant amount of supply that they've been holding back. And I think that they'll keep it in that range. I do think that in the medium term that there is definitely a possibility that oil could go significantly higher in the out years. The reason I say that is the investment that's being made in oil in general is on the downturn. Just looking at the majors in the U.S., Exxon or Chevron, their budgets, Shell, their budgets for capital expenditures, they had significantly cut their last year, and they had made projections of what they would think that they'd be spending this year, and they're coming billions of dollars underneath that, and on percentage wise maybe 10%, 20% less in their capital expenditure budgets. So that's a big indicator of what future supply will be like. So when I see that, I see constrained future supply in oil, 2 and 3 years out. I believe demand will rebound and is rebounding as the economy opens up, and eventually the Delta variant will pass us by, and people will be, the world will hopefully be vaccinated, and this will be a thing of the past, and oil consumption and travel and all the things and commerce that goes along with that. So I see supply rebounding back to normal over the next 12 to 18 months. And the out years of supply, looking at that same period and extending, going 12, 24, 36 months, I see that being constrained in oil. So I believe that the overall trend will continue to be up, and that oil prices will stay relatively high. I don't know whether we can expect a spike to something like $100. Some people have called for that. It could certainly be a possibility, 2 years out, depending on the kind of economy we have and what's happening. But I think certainly, $70 plus oil is a possibility in out years. But in the near term, I think as we're opening up and as we're figuring out where the various economies in the world are going to be, and we're still dealing with the pandemic, I think 60 to 70 is kind of where we'll sit for a while.